Hey everyone, welcome to another edition of our Smart Investing Weekly Stock Analysis, where we take a look at a popular company. Might be a buy, might be a hold, might be a sell. If you find the information here informative today, be sure to hit that subscribe button below so you're notified about our future videos. Today, kind of picking a company more, I guess, on trending news rather than a trending stock. And what I mean by that, I think there's no secret that we're kind of brushing up against some rising interest rates right now.
Yeah, and what you look at, the banks, the financials, things that will benefit from rising interest rates, because as those rates go up, their spread increases, which hopefully increases their profit. So that's why you look at companies that can benefit from rising rates. Do you want to give the thing we're going to talk about today yet, or you want me to?
Well, I was going to say too, kind of on that topic real quick, it's also important to make sure there's a good spread because you want to make sure the Fed's balancing between the long end and the short end. Because if they're just raising the short end, all of a sudden the banks aren't making that much money because the spread isn't that great. They need to make sure they're also extending the long end, which is where I'm going to call it the quantitative tightening, rather than letting the bonds run off the balance sheet, kind of changing that methodology. That's what's going to, I think, extend the long end of like the 10-year note and mortgages and things like that nature, which should be beneficial for the financials. With all that said, the company we're going to talk about today is MetLife, insurance company here, a little bit different than a bank, of course.
They really are, and they can benefit because they actually do have interest rate sensitive products in their portfolios. That's how they pay out their claims, they invest that money and so forth. So it can benefit them, but you got to be careful with insurance companies because they can actually invest in other things which may not benefit. So you got to look deep and keep in mind when we show you these videos here, we're showing you how to get started on the research and why it may be a good idea. It takes a lot of time before we invest in any companies here, any equities here at Willis Asset Management. It takes us 10, 15, 20 hours of research. So don't just say, oh, they said this was a great company. We just are trying to find ones to do more research on, or say, don't even waste your time on this one.
I was going to say too, before we get into the numbers, the insurance companies are also very interesting because they also many times have a large investment kind of book that helps generate earnings. And rising interest rates is a benefit, but also a negative to them because many times they have those fixed income products in their investment portfolio. The negative side is as interest rates go up, bond prices go down. So the principal of the bonds they hold could decline, but they're having new money flow into that, which is going to be actually accretive in terms of the rising interest rates because that'll help with now more income from the higher interest rates. So it's kind of an interesting offset that you'll see in the investment portfolios for these insurance businesses.
Also, too, I mean, we do hold an insurance company in our portfolio, but we know what they've been doing with their portfolio. They have been shortened for, gosh, I want to say 2-3 years. They've been shortening their maturities, knowing that rates are rising. So they are sitting in a pretty good place. Now, if you do, we talk about this insurance company, let's give a name. It's MetLife. We're going to talk about MetLife, and you go in the front of the portfolio, still long duration, 10, 20-year bonds, you're going to realize that's going to be a problem for them. So these are the type of research details you got to look into. We're trying to find things and ideas for you to go with that would make some sense.
And kind of talking about the research too, I briefly looked at MetLife, and I generally associate them with life insurance. But it looks like they've kind of ventured out and expanded the business. I saw things like pet insurance. They also have a lot of, they call it workplace benefits. So I'm curious what part of the business that's in. Is that kind of beneficial where they're not selling insurance anymore? Maybe they're getting some revenue from other sources. I know too, it looks like they also have investment management. I don't think they're as good as us here at Willis Asset Management.
Of course not. Of course not.
But they do have that as another stream of income. And I think they sell annuities as well. But, I would want to understand a little bit more of the breakdown of this business before we wanted to buy it.
Again, Chase, that's a good point to bring up because you want to understand where they get their revenue from. Again, I kind of looked at them as well as a life insurance annuity business, but they have other things as well. So this is what we talk about. You can't just jump in just because the numbers look good. Understand the business as well to make sure that, yeah, they're expanding, they're doing other type of insurance. I know the company that we own, the insurance company, they have, 4 or 5 different types of businesses they're going into. So a lot of different things you got to look at as opposed to just like, oh, the numbers look good or I know the name. Understand the business is what you got to do.
So with that, talking about understanding the business, let's understand some numbers here. We're getting MetLife, ticker symbol is MET.
And you can see right there, the industry is the insurance life business. Not much float on this at all, 1.1%. I will point out that generally insurance companies are pretty safe, conservative investments. You're not going to see them go up 50, 60% in 1 year, but you should not see the other side either, unless there's big claims for, if they're homeowners, stuff like that could be big claims there. But again, understand the business. We're looking at the last reported period right now, September. Those will probably be coming up pretty soon with a new year. Look at the PE ratio here, a little bit high at 10.9. I say that because the industry is at 8.4. We do see price to sales at 0.9, above the industry at 0.6. Now, price to tangible book value, it looks very good, 0.9 versus 3.9. That's a positive, means you're paying less than 90 cents or paying 90 cents on the dollar for the tangible assets of MetLife. Price to cash flow also looking a little bit expensive, 4.7 versus 3.4. And these valuation ratios, keep in mind, you want these lower than the industry average, but the PEG ratio, the price earnings divided by growth, looking good at 1, well below the industry at 9.8. So that's a good number there. Look at the earnings over the past year. We see they're up 6.5, but look at the industry up 90%. You want to understand why the big difference there. Why is the industry up 90% and MetLife only at 6.5? Got to get the answer to that. 5-year looks a little bit different. MetLife 14.1% is the growth versus 12.8 on the industry. Sales growth, well, not good here, down 2% for MetLife, but that's still better than the decline at the industry at a negative 6.4. But the 5-year growth for MetLife at 1.8 does not compete with the industry at 6.8. You do get a nice earnings per share growth over the next 5 years by the analysts of 8.6%, almost double the industry at 4.5. Now, nothing nice about insurance companies, they generally pay nice dividends. What we see here, the dividend yield is 2.9%, and they only use 30.9% of their earnings to pay that out. So that's a pretty positive thing there. We also do see 9 consecutive years of paying out those dividends. And the buyback yield shows how much you're kind of putting back into the stock by buying stock, paying dividends. Pretty good here, 6.7%, well above the industry of 0.5. That's a positive there. Now, insurance companies have a different balance sheet. That's why you're not seeing the current ratio, the quick ratio is not there. You do see a debt to equity of 0.3 versus 1.6. That is a positive. Looking at the net profit margin for MetLife, 8.3% above the industry at 7.2. I like seeing that. What I'm not liking here is return on equity, 7.7. Why is that below the industry at 12.6? Even return on invested capital, 7.2 versus 9.9%. So kind of disappointing, those numbers. Kind of get a mixed bag here so far. Some are good, some are bad. What do you see about going forward here, Chase?
Yeah, so current price for MetLife sees $66.06. It is brushing up close to that 52-week high of $69.16, and the 52-week low was $47.69. See, year to date, even with a massive decline in the indexes, you see MetLife's actually up 5.7%, kind of bucking the trend, as I just mentioned. Looking forward, I do want to kind of mention it is a large company. I think we all know MetLife, but $55.6 billion is the current market cap for MetLife. Like I said, we always want to look forward to see what we're paying for those future earnings. I'm going to go out to December 2022 right now. You see estimated earnings per share of $7.18. Well, that would give us a target sell price, let's see, using our 16.6 multiple of $119.19. So that looks attractive. Also, too, we do know that they're reporting next week. Now, this number I'm not as strong with on December 2023, but we will be shifting here shortly. Just out of curiosity, we take the 789. That gives a very attractive target sell price of $130.97. So going to be very interested to see what the numbers look like for MetLife when they report. I'm guessing it's not going to be anything that blows you away generally with insurance businesses, but definitely something that could have an impact on this target sell price going forward.
And Chase, let me just interrupt you really quick. I do see here December 2021, the year was $8.46. I'd want to know why the drop of $8.46 down to $7.18 or $7.89. What happened in 2021? Could be because of COVID, but I just want to know the answer to that question. Why was it so high in 2021? Because we like to buy companies that grow their earnings going forward. Was that just an anomaly, 2021? But understand that number as well.
Yeah, it's interesting you bring it up because, like with banks, they had to take those loan loss reserves. So that created a big issue there. well, what did the insurance company, or what did this insurance company do? Because this definitely, I don't want to call it financial engineering, but this definitely looks like some type of financial reason, not a business issue. You have 37% growth, which is really outside the norm for this company, followed by 15% in terms of decline. That's telling me more it's related to, I'm going to call accounting rather than business practices.
Could be. Yep.
So with that, I hope you guys found the video informational today. And if you did, be sure to, again, hit that subscribe button below so you're informed about our future videos. Just as a reminder, today's video is for informational purposes and it should not be used as investment advice. If you're interested in learning more about our investment firm, Wilsey Asset Management, be sure to visit our website, smartinvesting2000.com. Thanks for joining.
Have a good one.